This is James Eng. Thanks everyone for joining. And this is really on multifamily finance. I'm going to spend about 30 minutes and then take your questions. So here's the agenda. I'm going to really focus on sort of multifamily financing from the beginning, sort of how to get started in this business. I'm going to take you through some case studies, and then I'm going to talk about forming your sponsorship group, and then the current financing market. So let's just jump in here. Let's see. All right. So a little bit of my background. I've spent the last 15 years in commercial real estate. The first 10 years were really in at GE Capital as a loan underwriter. And then for the last 5 years, I've focused in on multifamily lending and done about 800 million across 125 properties. And then I've also invested in close to 7,000 units, sold about 1,000 units just in the last probably year to year and a half. So about right now, I'm in about 6,000 units across 21 properties here in Dallas, Austin, and San Antonio. So here is a snapshot of the 4 loans that almost every multifamily investor will use at some point in their career. So if you start on the left-hand side, this is just your standard bank loan. So this is a recourse loan. So if you've invested in single family, recourse loans are going to be your standard loan where if there's any issue, basically you're putting up a personal guarantee for it. So if there's any issue, if you get foreclosed on and there's a deficiency, you're going to be responsible for that, and they can go after your personal balance sheet. So these loans, the recourse bank loans, are 3 to 5 years typically, 1 year interest only, and then it goes 20 to 25 year amortization. And the max LTV is typically 75%. And the occupancy is flexible, and a lot of new investors will use this loan as they get started. And then as they get more experience, they'll move into Freddie Mac small balance loans, Fannie Mae loans, and these typically start at about $1 million. The loan terms are anywhere from 5, 7, 10 years. You usually get 1 to 3 years IO, and then it goes 30-year amortization. You can get up to 80% LTV. And these need to be stabilized properties, so 90% occupied for the last 90 days. And these are typically for more experienced operators. And Freddie Mac small balance loans, they only go up to about 6 million in most markets or standard markets. And in the top markets, there's about 5 or 6 top markets, and they can go up to 7.5 million. On the Fannie Mae side, you can do as high as you want to go. So you can buy any size loan on the Fannie Mae side. And then on the last column here on the right, the non-recourse bridge, those are going to be for more experienced operators. $5 million is the typical loan amount. 3 to 5 years, 30-year amortization. After typically you're getting IO the whole time. And it can go up to 80% loan to cost, and it's a flexible on the occupancy, and you typically have 1% prepay. But the underwriting on those non-recourse bridges are typically for more experienced operators. So I like this analogy. One of the we had a conference and I brought in some ice cream, and I like the analogy of like each one of these loan products is like a different type of ice cream. And you can think of a mortgage broker as, a Baskin Robbins of loans that are available. And so let's just start off. So we talked about recourse bridge. I called that a rocky road type of ice cream. And that's number one, because a lot of people move from single family to multifamily and they want to go to non-recourse. And sometimes people think you're nuts if you're signing recourse. So I use rocky road. And like we said, this is not stabilized, quick close, low prepayment penalties. If you move up to the top, Fannie and Freddie small balance, that to me is sort of like your vanilla with sprinkles. This is, non-recourse, 80% loan to cost, stabilized. Typical loan terms are 5, 7, 10. So a little bit more longer term loans. And then for non-recourse bridge, I called that your coffee ice cream. So this is sort of your high energy, high value add rehabs, floating rates typically, and then it's only a 3-year loan term. So you have to get in there, really turn the property around, and then refi or sell the property. All right, so let's look at this example. This was a deal in Fort Worth that was purchased earlier this year, 3.6 purchase price, pretty big rehab, 700,000, so it's close to 10 a door on rehab. It was 95% occupied, but the rents were 20% below market. And so let's go around sort of the ice cream shop here and let's look at the different options that the buyer had. Fannie Mae, they were at 2.9 because they were constrained on the debt service. So 125 debt service coverage. Gave you 3 years IO, but it was a yield maintenance prepay. Freddie SBL, it was a little bit less on proceeds because they had a higher interest rate, but it had a step down prepay, which is typically, let's say on a 5-year loan, 5, 4, 3, 2, 1. And that's the percentage of the loan amount that you would prepay. And then non-recourse bridge, this is under 5 million. They could give you up to 80%, but it was close to a 6% interest rate on a 3-year term. And then recourse, they were 75%. So you could get more loan proceeds, but it was a 5% interest rate over 5 years. And so on this one, they actually ended up going Freddie SBL on this one. And a couple of reasons: they didn't want to do recourse. They didn't want to have a floating interest rate and a short loan term. And so they went with Freddie SBL because of Freddie SBL's ability to offer step down prepayment. And that is a lot more, it's a lot easier for when you go to sell the property. You can offer the deal free and clear. So they went with Freddie SBL on this particular one. Shadowwood, this was a 60 unit deal in Garland, $4.5 million appraised value. So we actually did this loan. He had a recourse bank loan on the property, and he was all in on the deal for about 3.4 million. And so we went out, got the deal appraised, close to 4.5 million. And so it's 100% cash out refi. And so we went to Fannie, similar 3.4 million, 75% loan to value on the refi. But again, it had the yield maintenance. Freddie Mac 3.4 had a step down. Non-recourse bridge, similar issue, 6% interest rate, floating rate, similar loan to value. And then the recourse, he had already had a recourse loan. So 3.4 million, 5%. And it had 1 year of IO and then 20-year AM. So on this one, again, they went with the Freddie Mac small balance loan because of the non-recourse, and then the step down prepayment. And they could also get up to 10 years fixed at essentially 4%, 4.25%. So let's go to the next one. Monterey, this was a deal in Fort Worth, 9.5 million purchase, 350,000 in rehab. It was under market rents. So let's go through the options. So on the vanilla side, Fannie Mae, they were 7.4 million, 125 debt service, about 4%, just under 4% interest rate, 3 years IO. They could not do Freddie small balance on this one because Fort Worth is considered a standard market. They are max loan on SBL. Freddie SBL is 6 million. And so they couldn't do Freddie SBL on this one. Non-recourse bridge, they could get probably about 500,000 more in interest rate or more in loan proceeds, but the interest rate, it was lower. So as you go above 5 million, there's just more loan providers for these products. And so it was close to 5% rate. And then on the recourse side, similar loan proceeds, about 75% loan to cost, but the interest rate was 5%. So these guys, they had previous single family experience. They had a little bit of multi experience, which we'll talk about later in forming your sponsorship group. But these guys, a couple of them worked at G with me, and essentially they decided, hey, let's go with Fannie. We'll get the non-recourse. We'll get the fixed rate for 12 years and 3 years interest only. And so what's nice about Fannie is you're going to get the 3 years interest only. That's what they decided to go with. And then in, let's say, 4 to 5 years, they decide, okay, do I sell the deal or I can just take a supplemental? So supplemental is an additional secondary loan that you go back to Fannie Mae with. And if you've raised the value of the property, let's say you bought it for 9.5, you did 350 in rehab, and now it's worth, let's say, 13 million. You can go back and get a supplemental up to 75%. So they could resize the loan and pull out the equity that they put in so far. So that's a unique option that the non-recourse bridge and the recourse loans typically do not have. The Azul was a 362 unit deal here in Dallas, 32 million purchase, 2.6 million in rehab. It was 94% occupied, but the rents were below market. And on this one, we looked at Fannie, way too big for Freddie SBL. Fannie was at 26.2, so 75% loan to cost, fixed at 3.75. And then we looked at non-recourse bridge. So this is where non-recourse bridge is interesting. It went up to $28 million. So it's about $2 million more in loan proceeds than Fannie. It was a floating rate 3-year term and a 1% prepay. Recourse was about 27 million, 5% for 5 years. So on this one, um, they essentially they would on Fannie they would have to raise 10 million. On non-recourse bridge they would only have to raise 8, and that is the decision they made. They went with non-recourse bridge. They went and started doing their rehab. This deal closed in 2018. Started doing their rehab, and are going to look to refinance 2 to 3 years from now off of that one. So this one's a little bit interesting. It was a 580 unit deal here in Dallas. So it had two prices when it went out to market. It had a $63 million purchase on a loan assumption, or 69.5 on new debt, because the prepay. So the prepayment penalty, there was still 9 years left on this loan. It was a Fannie loan, and it has $6.5 million prepay. All right. So um, it was a big prepay, because essentially the prepay is looking at where your current interest rate is versus the market, and the market interest rates are significantly lower right now. So on the loan assumption, you buy it for 63 million, you do a $44 million loan assumption, and you raise about $20 million. There's no interest only. If you go up to non-recourse bridge, they were willing to give up to 80% loan to cost. So $58 million loan against 69.5 of new purchase price and 3 million in rehab. So, or 3 million in rehab. So you're essentially going to be at maybe 14 to $15 million all in raise, which is about $5 million less. And in recourse loan was about 52 million, 75% loan to cost. So it's about $6 million less. And not many people are going to do a recourse loan that big. So it's really between the Fannie and the non-recourse bridge. And so I actually had a buyer who came in on the loan assumption, and they decided to go with the guy with the non-recourse bridge. So his price was a little bit higher. They went with the non-recourse bridge guy, and everything looked good. And then essentially at the end of the transaction, the non-recourse bridge guy ended up pulling out just because of all the COVID. Um, in terms of what we're going to talk about later, in terms of what's going on with the market. So the buyer actually ended up backing out of this deal. So that's one of the risks right now when you go in with a bridge loan or a recourse loan, or even a new Fannie and Freddie loan, is if there's a change in the market and you can't get that new loan, your earnest money is at risk. All right, so let's talk about the types of multifamily investors that I work with. Number one is sort of the individual. This is someone who's essentially going to have their own money to put down the down payment to qualify for the loan, who's going to find the deal, who's going to manage the deal. This is probably pretty rare. I mean, I maybe work with maybe 10 to 15%, maybe 10% of the people that I work with are just individual investors. Majority of the people are going to be on the general partner and limited partnership side. The general partner is going to put the deal together, and they're going to sign on the loan, raise the money, find the deal, basically finding new deals and raising equity. Whereas the limited partner is going to invest with general partners. And so what usually happens is, like, how do you buy deals that are $10 million? How do you buy deals that are $30 million? And it's really about forming your sponsorship group. And so let's just take an easier example. Let's say $5 million. And I hand it to you and I say, hey, could you close this deal in 60 days? And the structure typically is, let's say 80-20, right? So 20% is down payment, cash, $1 million in equity, $4 million debt and loan, right? So how do you qualify for a $4 million loan? Number one, your net worth needs to be greater than the loan amount. So your entire sponsorship group, let's say these four investors that we'll talk about later, their total net worth adds up to $4 million. So that's, check the box. Second one is your post-close liquidity. So it needs to be 10% of the loan amount or greater. So this is cash or marketable securities in your bank account, in your checking or savings accounts, from the key principals that are signing. And number three is you need prior multifamily experience. So let me give you an example. If your sponsorship group is receiving, let's say 20% compensation for putting this deal together, you might have a common breakout like this, right? So 9% might go to the guy who found the deal, he's raising equity. 8% might go to the guy with multifamily experience, and he's raising equity. Number three might be this guy who's raising equity and he's just signing with net worth and liquidity. He doesn't have any experience. He didn't find the deal. And then maybe 1%, this guy has a lot of net worth and liquidity. Let's add him to get to the $4 million in debt, or $4 million loan amount. And that helps us get there. So as you can see, like, most of the The most valuable things are finding a deal, the multifamily experience, and then probably third is raising the equity. The more common things are net worth and liquidity, and so they're gonna get less compensation when you go to form your sponsorship group. Um, so let's go through. So that was sort of so all of this was sort of pre-COVID in terms of the background, the typical loans that we did forming your sponsorship group. And so let's just jump into more. The second half of the presentation is more around sort of what's happening right now in terms of the market. And if most guys know Ken McElroy, he's a rich dad advisor with Kiyosaki, and he did this YouTube video, and I thought was good. And it really showed the sort of, I think he described it as more like ripples in a pond. And COVID-19 hitting, unemployment now skyrocketing up to 30 million, the Fed hitting stimulus, defaults happening, bank REOs, and then that sort of 12 to 24 months, that's where he's saying it's going to be time to buy and hitting inflation. So I thought that was a good description out there, and I wanted to go we're going to go in that order in the next couple slides. So in 2008, it was really securitizations went bad, banks went bad, borrowers, liquidity froze up essentially, and then that hit the economy. This is the exact opposite, right? So the economy is halting, tenants aren't paying, borrowers aren't paying, banks aren't paying, and then banks aren't paying investors, and thus securitizations are drying up. And so the government has essentially put money at the front of this deal and said, look, we're going to send stimulus, we're going to increase the unemployment checks so that tenants have money and they can pay the rest of the people through the process. A couple of charts. I mean, everyone's seen sort of unemployment, hitting now, I think 30 million people who have filed in the last month or so. And, I think we increased the number of jobs by about 20 million in the last recession, 22 million. And so this was a chart from Moody's that showed, I mean, unemployment hasn't been this high since the 1930s depression. And so I like this chart because it gets you outside of the economic cycle and sort of talks about where banks are at right now. And at the top of the chart really talks about what, in an up market, how banks react, right? So at the beginning of a cycle, let's say this is 2012, 2013, there's really not that much bad news, right? And so lending, investing, everyone's bringing more capital to the market. So I would say, number 4, number 5 on the top, where financial institutions are providing more capital, it would say is probably 2014, 15, 16. And then number 6, lenders competing for market share. I would say that's probably the last 2-3 years where Fannie and Freddie are giving more IO, they're giving more leverage, they're giving bridge loans, they're giving 80% loan to cost. And that all essentially shut off mid-March. And now losses are causing lenders to be shy. They're raising interest rates, they're raising credit restrictions, covenants, and there's less capital. I talked to 2 large regional banks here in Dallas on just a standard multi-deal on a recourse loan with an established, experienced operator, and they're just saying we're not lending right now. And so less capital is available for borrowers, and eventually that's going to cause number 4 and number 5, right? So companies are going to be starved for capital. They're going to lead to defaults and bankruptcies. But eventually, as the economic contraction starts to turn, people are just going to start lending money, right? So family offices, private investors, they're going to start lending money to people at, higher interest rates, let's say 8, 9, 10% interest rates. And people are going to get drawn into those returns. I mean, the savings account returns are like 0 or negative right now. And so people are eventually going to start drawing in for those higher returns. And so here's a couple stats that I pulled from Freddie Mac. This one was sort of interesting. It said there's 327 Freddie loans currently in forbearance, and that's across. So this is about 1.7 billion, which is about 1%, less than 1% of their total unpaid balance. And so, unfortunately, so the K deals are sort of your more conventional deals. And then the small balance loans are over here to 253. So there's actually, close to 3% of the loans on the Freddie small balance side are in forbearance right now, are about to go into forbearance. And so, they said, look, the small balance loans, They're typically more workforce housing. They're not like your A and B tenant or class typically. So on the larger Freddie Mac conventional, most of those deals are A and B quality deals. The small balance are typically B and C. So they're seeing a little bit more hurt on the B and C side. This was Fannie Mae, so this just came out at the end of April, and they said, what is our list of Fannie deals in forbearance related to COVID? So this is a little bit, I think this is a little bit lower than all the deals, obviously, that are in forbearance for whatever reason. I think this list is very short right now, and I think it will be increasing shortly. Um, and then on the CMBS side, I mean, I focus on multifamily, but on the hotel side, they're seeing nearly 20% of all hotel loans basically are in a grace period, which basically means they didn't either pay their April payment, are asking for forbearance or asking to be switched to a special servicer. And then retail loans, I mean, 10% of those guys have already, reached, they didn't pay in April. So I think, in terms of, Fannie and Freddie, being, 1% compared to 20% and 10%, I think that speaks to the resiliency of the multifamily asset class. And here's just a snapshot of, so the way CMBS works is essentially they take a group of loans and then securitize them into different pieces. And you can buy any of these pieces. They can be AAA rated all the way down to triple B. And, securitizations basically don't work if your triple B spreads go too high. And that's what happened in the last, I would say, month or so. And so it's been very difficult for CMBS loans to get securitized, which means people don't want to do those loans. So that's why I didn't really talk about CMBS too much in the initial slides. And so here we are today, right? So I like talking about two keys during crisis. Number one, being insulated from forces that require selling, and number two, be positioned to be a buyer. So being insulated from forces that require selling right now is really, you don't want any near-term maturities. I would say the next 12 to 24 months, no near-term maturities. And number two, you have to make sure you have enough money to pay your debt service. For people who don't pay their debt service right now, the only option really is forbearance or a capital call. And so I would recommend, if you can do a capital call, do that, loan the money from the GP to the entity to sort of make it through. But if you don't have that money, you're going to have to do a forbearance and really try to get your operations up. So on forbearance, Fannie and Freddie have essentially come out and said, look, you can give it 90-day forbearance, but you can't evict tenants. You have to pay this back within 12 months. You can't do any new loans, and any cash flow we're going to sweep during this time. All right. So there's a lot of negatives for forbearance. On the new loan side, so Fannie and Freddie have different rules, but similar. Basically, they're making you put up 12 months of an interest reserve. On the Fannie side, 12 months P&I, taxes, insurance, and replacement reserves, and you have to hold that up for 12 months. So that's about 10% of your loan amount, or a little bit less than 10% on a larger loan. And then on less than $6 million loans, it's 18 months of P&I. So that's probably more than 10% of the loan amount. Luckily, on the Fannie side, there are no additional interest reserves on assumptions. And on the Freddie Mac side, let's jump over there. They're making you put up 12 months, also a P&I, and they're doing the escrows for taxes and insurance, but it's just typically like the 3-month escrow that you would do. But they have now, similar to Fannie in terms of pre-review, they have sort of markets of concern that they want pre-screened. So Houston, New Orleans, Orlando, Nevada, Oklahoma, basically any markets that are based in sort of tourism, high concentration of energy, they're going to want higher debt service, lower LTV. They're doing that on refis as well. And then we're seeing some of the Freddie Mac small balance loan servicers pull back. So there's essentially 12 people who have licenses with Freddie Mac small balance. And about half of them are just saying, look, we're just adding additional layers of underwriting. So Freddie might be at, let's say, 70% on a refi. We're going to do 65. Freddie might be doing small loans or very small markets. I'm not doing any very small markets. And Freddie has essentially gone back to these servicers and said, look, if any of your deals that you originate go bad in the next 18 months, you have to buy them back from us. And so they put in this change just in the last month. And so that's caused a lot of hesitancy for Freddie Mac small balance servicers. So here's where rates are. I mean, I wish people could have these rates forever. But on the Fannie Mae side, let's start on the left side. Came out today. So they have a floor on Treasury. So 10-year Treasury, last time I looked, I think was like 60 basis points. They have a floor of 90 basis points. The spread is 235. So you're about 325 on an 80% loan to value fixed for 10 years. On the SBL side, let's start on sort of that middle section. If you go 80%, you're probably right around that 4% range on a top or standard market. And then if you add, a different step down prepay or something like that, where you want a lighter prepay, it's going to add basis points to your loan. So, both, Fannie is extremely low right now, but that is not locked until the very end of the loan. Whereas Freddie SBL, you can lock that rate in today at loan application. And so that's it. That is all I had. I appreciate everybody tuning in. If you guys want to put in, let me pull up the chat here and let me see if you guys have any questions on any of the slides. I will go through those questions now. And yeah, I'm going to send everyone who registered, I'll send out the copy of the presentation because I know that was pretty quick. Let's see. All right. So one of the questions was around, I need to make this bigger here. Hold on one second. So one of the questions was around supplementals on Fannie. So let's go back to that slide real quick. All right. So on this one, so on Fannie Mae, let's say, so we actually have a deal right now that's on the market, and the existing loan's about $4 million. And if you got the supplemental, you would essentially have to put up like 500,000 in reserves. So they look at the loan that's being assumed plus the supplemental, and then you're either going to fit in this bucket of over 6 million or under 6 million. And it's 12 months. Over 6 million, it'd be 12 months P&I, 12 months of taxes, 12 months of insurance, and 12 months of replacement reserves. And they look at that, like that's how they came up with the calculation, but they look at it as like on the $7 million loan, 500,000 in escrow, they look at that as sort of like a lump sum. And that lump sum is not going to be released until, first of all, they're going to wait 6 months. And then they're going to need 2 consecutive quarters of 125 debt service coverage. And that's going to be, so essentially you're going to have that up for about 12 months at a minimum. And yes, so even if, like, let's say you go get a new loan, I think this is the next question. If you do get a new loan, and let's say you get 3 years of interest only, even if you have 3 years of interest only, they still require you to put up the PITI, so principal and interest on your interest reserve. So Nate asked this question around, what do you think is more advantageous for buyers, assumptions, or new loans? Right now, if you can do the loan assumption, that is going to give you the most certainty of execution, because right now all these rules have changed. In March, I mean, we had a couple deals. We had the loan commitment from Fannie Mae, and they essentially came out and said, "Look, I know we gave you this loan commitment, but now we're going to have you put up these reserves." And so I think there's just there's so much uncertainty right now. The last thing you need is more uncertainty around your loan proceeds, right? So if you do assumption, you get a lower basis, right? So go back to that other deal that we looked at. Essentially, you got a $6-7 million discount on the purchase price, and you're going to come in, the exact loan amount that you're going to get, the interest rate, so you can model that and build that into your price. And whereas on a new loan, there's just a lot more interest rate volatility, a lot more interest reserve volatility. and then you might just get declined outright, and then your earnest money's gone. So I would say loan assumption with financing contingency, and then probably um, bake in probably 75 to 90 days to get the deal closed. Let's see. So Brad asked about supplementals and then the LTV and rate these days on a Fannie Mae supplemental. And so most loans right now, let's say they're in that 3 to 4% range. Supplementals are usually going to be about at least 100 basis points higher, and the max on a supplemental is going to be 75%. And so if you, yeah, let's say your purchase price is 10 million, the existing loan is 6 million, you can get up to 1.5 on your supplemental, but then you're going to be putting up that reserve that we talked about in terms of 12 months P&I, taxes, insurance, and then the rate. I mean, the rate before all of this was on supplementals were typically 5 to 6%. So I would probably model at least 5.5% on a supplemental these days, just because you just can't. There's a lot of volatility in that market of supplementals. All right, I think I got all the questions. Any other questions? All right, here we go. Um, okay, so this question is around what conditions a deal sponsor would have sort of a negative black mark on their borrowing history with, let's say, Fannie and Freddie. And a lot of times on your loan application, you have to um, write in: have you ever declared bankruptcy? Are you in any lawsuits? Have you taken forbearance? Have you ever done deed in lieu of foreclosure? So if you do take forbearance right now, going forward, you're almost always going to have to put that in your loan application. So I would say, I mean, you could explain it away with, look, it went through COVID-19, and that was the issue. Um, and I think in the short term, people will remember this crisis, but you know, 3, 4 years from now, I don't, it's still going to be a negative mark on you. And so I don't think it's going to be bad enough where you will not get the loan. But Fannie and Freddie are going to remember the people who had reserves, people who maintained their property and could make it through this storm that we're going through. And I think it will be more around. So when we talk about the credit cycle, when loans, let's say in 2016, 2017, if you have an outstanding history with Fannie and Freddie, they give you sort of a stamp. It's called like, a select borrower, things like that. Freddie Mac gives you a sort of a stamp once you hit a large enough number. And those people get preferential pricing. They get better interest only. They get higher LTV if they want it. And um, I think that's what will impact you more is if instead of 3 to 5 years IO, you might get 1 to 3 years IO. And instead of 80% leverage, you might get 75. So I don't think it'll be um, negative to the point that you won't get a loan, but it will it won't be ideal for you. Okay. The next question is, when do you expect to see a spike in distressed assets? Um, so here in Texas, in April, collections were essentially, I would say, probably 5% below March. And so we saw Class A collect at 98%, Bs at probably 96, and then Cs at anywhere from 90 to 94%. On the May collections, I'm still gathering data for that, and I'll probably put out something in the next week. But I think it's going to be a little bit less than April, but not nearly the decrease that retail and office and hotels saw. So I on multifamily, where I'm seeing deals break, and I put out a video on underwriting broken deals probably about 2 weeks ago. And where I'm seeing deals break is if they already had issues pre-COVID, right? So let's say you're doing a major reposition, you were cleaning out the tenancy, you were 80% occupied, and now all of a sudden COVID hits in March, and 60% is your collection number now, and yeah, barely covers your expenses. Now you have to feed the deal, right? That's an issue. Or if you bought a deal in 2017, 2018, you spent all your reserves, and now COVID hits, and you were close to a place in Florida with tourism, a lot of that industry or energy, then you're having issues on more on the concentration side. So in Dallas, I have not seen a huge number of distressed assets. The assets that we're seeing right now were the ones that they were probably going to go down in these months, regardless of COVID. It's just been exacerbated. It's been sped up by COVID. Um, so I don't expect distressed assets really um, to be hitting most of the people who have to sell right now because of the loan maturity or because of pre foreclosure. I think it's going to be pretty light. I mean, if you go back and look at the deal volume in 2008, 2009, 2010, I mean, it was probably 10 to 20% of what it was in 2007. And what happens is it's going to slowly make its way back, but it's going to be a 2 to 3 year process. And I like Ken McElroy's. If you look at his sort of ripples in the pond, it takes a while. I mean, I just saw a house. I get foreclosure data, and the bank had foreclosed on this house near my house like in 2018, and it took them 2 years to list the property. I mean, this stuff takes a while to go through the defaults and then the banks putting out their REOs and that impacting pricing. And so I think that's where Ken has his projection at sort of that 12 to 24 months. So I think I mean, we've only been like a month, 2 months into this thing. So I think it's going to take that long for sort of the banks to foreclose and put that stuff back on the market. All right. Next question is this person has a owner that wants to sell, but they just closed on a refi. What financing scenarios can I present him in order to sell? So if someone just did a refi, then most likely the new buyer is gonna have to do a loan assumption. And so if you do Fannie Mae or Freddie Mac, that can be assumed. If it's a recourse loan, as long as they're not in a lockout period where they have a prepayment or a lockout for 12 months, then they can just pay off the loan, and the new buyer can come in with new debt. But most likely, if they did Fannie or Freddie, Nate, they're going to have to just do a loan assumption. Next question was, where do you see post-pandemic discount percentages landing? I think on the coast, there's going to be some huge discounts. So in those spots that, and I'll put this up on the next video that I do, but in places like that are very tourist dependent, I think everyone's highlighted sort of. Let's say Orlando and Las Vegas, those places where you just have not seen, you've just been hit dramatically and people are just leaving those cities. I think the discounts are going to be 20, 30%. But in areas like Dallas or Austin, places that, the collections really haven't changed. I mean, they're down a little bit, but they really haven't changed. I think it's probably going to be closer to that 10 to 15%. Okay, so next question is, how much time will it take to close a loan once a property is identified for a person who is just starting in multifamily? So the best thing to do right now is sort of, and I use this quote a lot on some of my pitches, is like, this is your preseason as a multifamily investor, right? And if you think in the next 12 to 24 months is going to be the time to buy, this is your preseason to get ready for the regular season and playoffs coming up. And in terms of pre-qualification, what I like to usually do is set up a time with you, sort of set up your or put together your personal financial statement. I can send you a template with that. And then from there, put, sort of your assets and liabilities. We'll go through it, look at how much liquidity you have, and then figure out what markets you want to purchase in, who's the listing brokers you should know. And then really start looking at the data and looking at markets, understanding markets, learning about property management companies, all that type of stuff, so that you can start the process. And so that when there is a deal, then you'll be pre-qualified and ready to go. So this question is around forbearance data. Let me go back. So Freddie Mac put out their forbearance data. You can see in the bottom right, it sort of has the percentages by forbearance request. I have not. I'm working on this. If anybody out there knows how to get this, I'm working or trying to find these loans specifically, or that data. Right now, Fannie and Freddie have put out this data on their website, and it's public information, but I have not seen it for um, loan by loan, submarket by submarket at this point. Let's see. I think that is all in terms of questions. I think I got them all. Well, let me just wrap with this. I appreciate everyone for jumping on the call. And if you have any questions about your next multifamily property, whether you're refinancing or buying a property, you can give me a call, shoot me an email, or if you haven't watched any of the videos, sort of just go to youtube.com/James Eng. I put out, 1 or 2 videos a week, especially during COVID. I probably put out 20 or 30 videos of different scenarios and different things that I think multifamily investors should be looking at. Definitely check that out. And if you have any questions, definitely reach out to me. I appreciate everybody jumping on the call. Thanks a lot.